there's a lot of optimism, and that wasn't the case last fall. A lot of people were quite negative, expecting a market correction, expecting the broader economy in the U.S. and in Canada and globally to enter a recession, see interest rate cuts by now, and so they were herding into only a few names in the S&P 500 and heavily selling off cyclical names that would benefit from a stronger economy like energy and utilities and others.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the host of this conversation today. And I'm really looking forward to it with a first-time guest here on the channel. It is Martin Pelletier. He's a senior portfolio manager over at Trivest Wealth, and they're part of the Wellington-Altus Private Counsel. And I'm really looking forward to this discussion because he's based in Canada. He's in Calgary, so he can give us a bit of a different perspective on the markets. We'll throw in the Canadian markets into the mix as well. How does that fit into the overall scheme? How is the economy doing in Canada? How is it affecting global markets? And we'll try to draw some comparisons between the US as well here. Before I jump into the conversation with our guest Martin here, please hit that subscribe button so we can bring guests like Martin onto the program more often, more regularly, and we can expand our reach. It's truly appreciated, and really appreciate that. So let me bring my guests on, or my guest on is just one. Martin, it's really great to have you on the program. Thank you so much for making the time.
Awesome. Looking forward to this chat, Guy.
Oh, absolutely. Yeah, no, let's dive right in as well. Let's talk about how is the market doing? How is the economy right now, and how strong do you see it?
There's a lot of optimism, and that wasn't the case last fall. A lot of people were quite negative, expecting a market correction, expecting the broader economy in the U.S. and in Canada and globally to enter a recession, see interest rate cuts by now, and so they were herding into only a few names in the S&P 500 and heavily selling off cyclical names that would benefit from a stronger economy like energy and utilities and others. And so that didn't play out. That did not play out as expected. And if you look at the first quarter, actually energy beat out big tech for the first time in a long time. And the economy in the US is doing very well with the levels of unemployment and consumers continuing to spend and doing a lot better than what most people expected. And so that's being translated into some very strong market gains in the first quarter. So they're going to have a lot of investors are going to be quite happy to open their Q1 statements this month.
Absolutely. Yeah, no, the market has been rallying. S&P 500 is just below 5,200 right now. I think 5,150 or so. So it's massive rally since the end of October, almost 30% or more. So yes, they should be quite happy opening their portfolio in general. Lots to follow up on the things you've mentioned. And I'm trying to think, trying to put it maybe in order as well, because recession fears, I think, is a big one we need to talk about. They have dissipated. It's not being as talked about as much anymore. A lot of people talk about soft landing scenarios. So I'm curious, I have to ask you, Martin, what kind of camp are you in? No landing, soft, or even hard landing scenario?
Depending where you're situated. As we had just chatted previous to here, I just got back from Costa Rica and observing what's going on south of the border, way south of the border in Central America. Certainly there's no recession going on down there. And a lot of the tourists were from the U.S. And so I think we have to take a look at different areas. The U.S. economy is very strong. You have the government running a deficit equivalent to when we had a 2008 financial crisis. So they're continuing to spend. And that's very inflationary, very positive for certain consumers from regards to backstopping the growth of the economy. Just a matter of, can that growth offset the increased inflationary pressures? It makes it very difficult for the Fed to decide to do what they're going to do. So I'm very bullish on the U.S. economy, not as nearly as bearish as many others out there. Canada, on the other hand, is setting up for the opposite of that type of situation. I talk broadly about Canada because Canada's, from a population standpoint and economic standpoint, still dominated by two large provinces, Quebec and Ontario. and high interest rates are really taking root and creating some challenges in the real estate market in those jurisdictions, offset by record levels of immigration. Now, a lot of that immigration is finding its way into Alberta, not only from new people coming into the country, but also people looking at affordability arbitrage, I call it, moving from Ontario into Alberta and buying houses for cash, for example. So Calgary feels a lot like 2002, and so that's very encouraging for those in Alberta. I really do think Alberta is probably going to be similar to what you would see in the U.S., maybe Texas, and have a strong economic cycle here, and whereas the rest of the country is going to be struggling.
Are those moves also politically motivated? I'm just curious as a thought, because a lot of people move to Texas because politics in the U.S. and I want to get into politics and specifics, but is that a reason as well why Alberta is becoming more interesting?
No, I mean, people like to pin it on politics. I really do think it's just when it comes down to your quality of life and the opportunities that you want for the next generation. And there isn't a lot of opportunities in Eastern Canada at this stage. There isn't a lot of growth outside of the public sector. The public sector growth has been phenomenal, whereas private sector is not. And that's quite the opposite of what we're seeing in the US. And so on a general level, from what the federal government is doing from the hiring standpoint. And in Alberta, it's different. There's a lot of opportunities here. Various sectors. We're attracting energy transition segments of the economy. We're attracting digital warehousing and other areas outside of oil and gas. And it's from a affordability standpoint, housing prices, although it's on fire here, is still significantly less than Vancouver or Toronto. And so if you can lock in some of those gains and take your family out here, pay cash for your house, be mortgage free, who cares about interest rates? Actually, you may care, because now you're getting some decent return on your investments, and your kids have a job, and your kids can actually buy a house, or you can take some of the cash and help set them up. So there's a lot more opportunities within the Western provinces, especially in Alberta.
Now, you already moved the conversation over to housing, but I want to stick on the recession topic just for 1 minute longer here, and ask the same question I've asked a number of guests on the program just in the recent past here. Is the US actually getting away with one here? Meaning, are they actually able to dodge the recession bullet?
I think so. And the reason being is you have to look at the structure of the US debt. And what I mean by that is the amortization period and term of these. You can go get a 30-year term mortgage. And a lot of them did that. We call it the great COVID refinancing boom. There's $450 billion of mortgages that were locked in during COVID at record low interest rates for 20, 30 years. So they don't really care about mortgage rates going to 7% when they're at 1.9. Whereas in Canada, we have 5-year terms on average, and a lot of people are going shorter terms than that. And that's now starting to come due, right? So you're 2000 when this all happened, and so now we're in the stages of those mortgages coming up for renewals and finding that your payment's going to go up a lot, or you have to try and convince the bank to extend your amortization to 50 years, and good luck with that.
Absolutely. No, Canada is a very different market I've experienced in terms of housing, just conversations I'm having here with friends just in North Vancouver as well. It's mortgages are being given out by the banks in 1 year and 3-year terms sometimes, and that is just mind-blowing to me. And I've been hearing that the banks are pushing lenders into the 3-year, which is still higher but lower than the 1 year.
No, we haven't seen. Despite that, we haven't seen housing market collapse. Despite, I mean, you would think the sensitivity would be that much greater. Well, when you let in 1 million people in 9 months, and you only build 150,000 homes, of those million, you're going to have a substantial portion that are be able to still, come with cash and be able to buy houses. So it's a double whammy for especially younger people. You have housing prices that are still staying quite high, and interest rates being quite high. And so they're not getting the benefit of falling asset prices. And so if you look at, I'm a huge fan of immigration, but not doing what we're doing, where we let 2 million people in a year and we built 250,000 home starts, and that puts huge taxes on all kinds of services, education, healthcare, all that other stuff, and so we have an affordability crisis. With the Bank of Canada wondering what to do because of all of that, and should they cut interest rates? And so Canada's are really in a little bit of a pickle here. And the nice thing is although many people who are anti-energy are going to actually be pro-energy when Alberta comes to save the country and save the currency with high oil prices, because if we didn't have oil prices, the currency would probably be a lot lower, and then we'd have even higher inflation. So that's the benefit of Confederation, is that we're well diversified. If Canada was a portfolio, Alberta is now stepping up to the plate to contribute to the rest of the country. Whereas, in 2014, it was the other way around, where Ontario and Quebec were driving growth with real estate and other segments. And that's an energy with OPEC coming in and flooding the market really hurt Alberta. Now we're getting that rotation back again. So that's the saving grace. Alberta's going to save Canada.
Yeah, absolutely. I fully agree. And but Canada is doing everything, or Ottawa is doing anything they can in their power to sort of not let that happen again, and maybe have that shift of power towards the West. Right? I think they're really worried about that. That's what I'm sensing.
We're Canadians, so we have to think as Canadians, not regional segments. So we have to look, say, hey, look, this is great. Thank you, Alberta. And we're gonna double down and help with that. So the next time this comes around, we're exporting LNG to countries who actually want to get it, Japan and Greece. When the prime ministers come pay a visit, they're like, hey, thank you. That was nice of you to give us some cheap natural gas. It's really helping our economy, and it's helping yours. So, hey, it's a win-win for all of Canada.
Yeah, I wish they think that pragmatically, because I think they denied an LNG deal to Germany, right?
Oh, so, Germany, so not Japan. Yeah, Germany. So
it was right. So that should have been a win-win for both sides, but there was a lot of short-term thinking, I believe. But that's a different topic of discussion. Let's talk about inflationary pressures. You mentioned that, of course, a lot of government spending, particularly in the U.S., less so in Canada. But the U.S. is just flooding the market with grants, various acts, and incentives in general to keep the market afloat. Let's talk about that. When do you expect that to really hit the bottom lines here, meaning the bottom line of inflation? Like, when do you see that really spiking up? We're at 3.2%, just small upticks recently, nothing too crazy. Where do you see inflation going?
I think inflation bottomed last November, and so you have the base effect. So if you look at year-over-year numbers, it creates a false narrative that inflation is under control. And as we move further and further along, and we have a lower base level to look back on, and suddenly it's not under control. The fact of the matter is that you look at the Yukon, for example. I saw someone post on Twitter $17 for 2 liters of milk, and that wasn't $17 2 years ago, and so people are quite upset, and rightly so. And more so that's in Canada, but looking in the U.S., which is quite strong, are they going to be able to grow themselves out of this situation, and without having some serious wage inflation, which basically locks in all of this? And so it's a really tough situation to be in. So I think we're going to have to be living with 3% inflation, 3.5% inflation going forward. This 2% target is coming. I mean, that's finished. COVID was a structural change in the market. Things changed in many different areas, just like it did in 2008, and which ushered in quantitative easing and deflationary pressures. I think that ended in 2020, and so we're in a new world right now where we have to live with a little bit of higher inflation, and that means higher interest rates. We're not going back to the way we were in pre-2020, pre-COVID, and so we're going to have to live, maybe not the same level as we're at right now, but certainly nowhere near where they were pre-COVID.
No, absolutely. And the question of deficit spending is one topic. We'll get to that in a second. But I just lost my train of thought. I know. I need to make no. I
Yeah.
was
So
going to talk more.
on the
No, let me
deficit.
just think so I can make a clean cut. Hold on, sorry, Martin.
Okay.
I was going to follow up on the inflation topic.
Okay.
Just okay. So, Martin, some of the trends we're seeing, you mentioned wage inflation, and I'm seeing the onshoring trend or reshoring
Mhm.
trend happening as
Mhm.
well, which is a big one.
Yeah.
It's like, what can the Fed actually do? Like the Fed is using old
No.
data and really lagging data as well in their forecasts. What should they be doing? Like what should they be looking at, and how can they anticipate a change? And same is for Canada here as well.
I think the Fed's done a good job so far of navigating that type of environment. They're in a real tough situation, especially in an election year, where a lot of things could potentially go wrong in November, depending on the outcome. And even then, no one really kind of knows what's going to happen. Reshoring is definitely one of those structural shifts that we're seeing. And what's interesting is that may not cause that wage inflation. If you look at for example, one of the companies that we've invested in on the private side has been acquiring machine shops throughout the U.S., buying out the baby boomer generation and financing it for the next generation to come in, paying them out, replacing aged entire with equipment with new technology and fabrication with artificial intelligence to prevent downtimes and increasing operating efficiencies by as much 40 to 50%. And so artificial intelligence and new efficiencies in regards to technology means that we can do this reshoring without increasing hiring a whole bunch of new people, having wage inflation, and passing along higher costs to the consumer. And so you're seeing profitability in corporate profitability continue to maintain its trajectory. And so that's why corporate profitability in Q1 was quite strong and beat a whole bunch of smart people in the room as to what they were expecting. And I think we're going to continue to see more of that. And so, is it going to be hugely deflationary? No. But is it going to be inflationary? Hugely no. And so it's kind of in that middle ground. Now the big question is what happens with China, and if for example the crazy man in the room gets elected again, and he goes the wild card, he goes after China. Like there's all kinds of stuff we don't know. But right now, as it stands, the U.S. economy is the best place in the world.
It definitely seems so. It definitely seems so based on the data we've been getting over the last 24 hours of recording here. That has been served to us. Labor productivity is an interesting one. I'm glad you touched on that because we can talk about AI in that conversation. How does AI factor in into all of this? How much credit do you give it, and how much of a factor is it going to be moving forward?
I think it'll just accelerate labor productivity, and it'll continue to dominate with the U.S. getting more and more market share. You look at Canada, I mean, we're lagging behind everybody on a whole bunch of different factors, technology being one of them. We have a client in Dubai, and they just can't believe the huge difference in banking, for example, in a technology standpoint. And, I talked with one head of a global asset management division of a bank, and they just phased out fax machines a year and a half ago.
Well, you still use checks here in Canada.
Yeah. Check.
My landlord used to ask me for checks. It's like, what is that? Like,
yeah, and I think that really describes. I mean, we're almost a culture of complacency, and so we're just well off. Our houses are done so well, we can coast. And when you become a nation of coasting, that does terrible things for your productivity. And you look at our labor product, you look at GDP per capita, it's been declining for 18 consecutive months. It's terrible. You look at Trevor Tolman at the University of Calgary, done some fantastic work on rating the provinces from a productivity standpoint on a GDP basis per capita, and how much are we contributing on a provincial standpoint and against the states. And Alberta was 14th, tied with Texas, and then Saskatchewan was 22nd, and all of the other provinces were dead last with Alabama and the southern states and Arkansas. I mean, it's just crazy. Not to say anything bad about some of the southern states, but those are the lowest producing states in in that country. And ourselves, we're ranked dead last in the OECD. We're continuing to lose productivity and market share. And this needs to end. I think we're going to be, not only an affordability crisis, but a productivity crisis in this country. And it all began, in my opinion, trying to keep politics out of it when Trudeau got elected and said small business owners were tax cheats. And small business owners were, at that time, the backbone of disruption and innovation and of hiring of people and productivity. And we've replaced all of that with public servant workers. And you don't get a lot of productivity when everybody works for the government.
How much of a factor is the deficit spending right now? The U.S. is flooding the market with cash. I mentioned grants. Just recently, the U.S. gave billions to Intel to invest $100 billion in 4 different states. Is that what keeps the U.S. ahead and maybe afloat right now?
Well, not afloat. I just think it just adds gasoline to the fire. And so as an investor, you want to own some of that. You want to have, from your portfolio standpoint, there's different strategies you can deploy, but if it comes to growth, there's no other place you want to be. Some people are starting to look at other areas because of discrepancy in valuations between the U.S. and other markets. But, you've got the Russell 2000, you've got other segments of the market in the U.S. That haven't tracked the megas, for example, that you can benefit from all of the things you just mentioned.
How much longer is that sustainable, though, Martin? Like that deficit spending, it's $2 trillion in the U.S. I'm not sure about the exact number in Canada, but it can't be positive, and I'm pretty sure of that. 99.9999% sure that it's not positive spending right now. So, how much longer is that sustainable? U.S. $34.5 trillion in deficit, over $1.1 trillion in just interest or servicing the interest on that debt. Where's this all leading? Where's this headed?
I don't know. I do not have an answer to that. And I think it ties into, you look at what's happened with the Canadian housing market. You would think taking interest rates from near zero to 5% would just completely destroy the housing market, and it didn't. You would think the same could be said about debt servicing costs. I've been reading about the expected. I think we're going to get an update on the deficit here in Canada. It's going to be much larger than what they said they're going to be, and so the big question is, how do they finance that? And there's no more room for tax hikes, and you just especially in Canada, where we've reached the threshold. When you get over 50%, people start revolting unless you get a lot more benefits out of it. And so you have to find other areas, and they're not going to cut. And interest rates, the longer interest rates stay where they're at, it's going to force some fiscal responsibility. So I think what's going to happen, the natural solution is a change out in governments globally, that not unlike what we saw at the extreme end in Argentina. You can have like a mini-me Argentina and some of these OECD countries. I think we're going to see a change out in Canada. Absolutely. I think there's, I read today that under the age of 50, the Trudeau government has 20% support by the Canadian citizens. So, I mean, they're done. And we're going to new government they'll come in and start doing some cuts, and they're going to be forced to. They can't force the Bank of Canada to cut interest rates to save them. They can't force them to buy their debt that they're issuing when inflation's where it's at. And the same thing's going to happen in the U.S. and same thing's going to happen in the UK or in other blocks. Now, you have to be careful as you go to the other extreme that they don't cut too much and get too aggressive with protectionism and all those sorts of things. It's a whole different discussion. But I think naturally things do mean revert. In nature, things cycle, and when things get out of balance, they rebalance. It happened in 2008, and so we're rebalancing from the shutdown of the economies in 2020. Does it mean it's going to be ugly? Is that going to be a catalyst for a big drop? Well, people have been saying that and trading on it, and they've missed out on some really strong gains the last 2 years. And so that's what I really do mean. I don't know, and I'm not going to trade on that because it's just not. I mean, economies and stock markets do things different things at different times, and if I keep looking at the U.S. debt level or Canadian debt level, I'm going to be paralyzed and sit on cash. Now, fortunately, cash is paying 5%. It's not going to pay 5% forever, and you miss out on some nice gains. And so They do really make for some great Easter dinner table conversations and podcast conversations, but they're not going to make any money.
Very difficult out there. Absolutely. Bond market is a different topic as well.
Yeah.
We'll talk about that. Elections in Canada, by the way, 2025. I just looked up the debt to GDP ratio in Canada. It's 107. Thought it was interesting because Canada is a topic or a country we don't talk about too much. Part of the G7.
On that include household debt and provincial debt, and it looks a whole. So everyone keeps saying looking at Canada federally, but I mean, so the only bastion of safety that we had was from the previous governments, the Chrétiens and the Harper government, that went in and cleaned up the federal balance sheet, and so and that's being destroyed as we speak. And so that was the only safety net that we had, because consumers went crazy with real estate and leveraging up, and provinces as well. They're not, and municipalities. And the only safe place was federal, and that's changing.
U.S. elections are coming up in November. I'm curious what your thoughts are. Like, how much are the U.S. elections already weighing on the markets, and how is the Fed sort of taking the U.S. elections into consideration as well? Should they even be doing that?
That's a heck of a question. Everyone's trying to figure out what's going on there. I think markets have moved beyond the Fed, so they moved beyond interest rate and expectation of interest rates. We needed interest rate cuts to save the economy. Well, lo and behold, the economy is ripping and doing a lot better. Not ripping, I mean, that's overemphasis, but doing a lot better than many people expected. It's not contracting, it's growing. Productivity is going well. The various states are doing well. And they're like, we really don't care. We don't need interest rates to fall significantly. We can do okay with interest rates falling a little bit, not a lot. And so I think they're looking past that. Now, when it comes to the election and the impact on deficits, foreign policy, that's a crapshoot. I have no idea. You have an existing government in the U.S. that has been very docile in regards to its approach of dealing with geopolitical. And as a result, we're seeing what we're seeing right now. It's just the worst I've seen the geopolitical side in my career. And I think it's probably going to get worse before it gets better on that standpoint, even with the existing government, and maybe even with if the new one comes in under the Trump administration, because he's a wild card. And maybe he makes things worse than better. And so that's probably a likely outcome. And so you want to position portfolios around that heightened geopolitical. The cost of hedging is really cheap right now. People are very complacent. So you've made some nice gains in your portfolio. Buy some cheap insurance to lock in those gains. Maybe add some energy and some utilities, some of the other segments of the economy that will do well in that kind of uncertainty, just to offset other areas. And so look at it as a means of risk management in your portfolio rather than betting on a particular outcome, because everyone bet that when Trump was elected, the market was going to crash, and they didn't. They went up. And maybe they make the bet that markets go up and he gets elected, markets crash. So we just don't know what's going to happen at that point. And so if you in the face of uncertainty, it's always good to be hedging.
They haven't been really clear on policy either. Like, it's really tough to find anything about fiscal policy or how are they going to deal with the debt situation. There's nothing like I could find so far in the financial media in that regard. So that'll be interesting to monitor. One last topic before, I want to get at your understanding how you're allocating and how you're navigating the markets is energy. You brought it up, oil and gas, just in your previous answer. Let's talk about it. How strong and what's your opinion on the oil and gas market and oil at $84 a barrel? Should it be higher? Should it be lower? What are your thoughts?
Well, I'm in Calgary. I used to be an oil and gas analyst for 10 years. And so I know the sector. But it isn't a huge part of what we do. But it's certainly a lot of fun to talk about. And so at one point we were seriously underweight the sector and overweight long dated treasuries, and we've since rotated that out. Fortunately, it worked quite well out of those long dated treasuries and into energy as an inflation hedge. And we haven't reduced that energy positions since then. We were looking to on potential recessionary concerns. But the geopolitical stuff is just off the charts, and OPEC has really stepped up to the plate. signal to the market, we are here to do business. We are here. We'll take lower volumes and higher prices all day long, and to the detriment of Biden, who's trying to get gasoline prices down ahead of the U.S. election. So he may have used up a couple of bullets already in the SPR, and there's not much he can do ahead of November. And so I'm a bull on energy, but it's not a huge part of what we do. It's probably an 8% weighting in our total portfolio. Now, that's of the total portfolio, which is probably, if you look at the Canadian equity weighting, we're probably a little bit less than what it would be in the TSX. And on a global side, a lot more than what would be in the S&P. And so, we've weighted towards the bigger companies, the C&Qs, Suncor's, which have done phenomenal. And now we're starting to go down market into the mid caps that have not done well at all, expecting a nice rally there. But, we're not, I call it going for base hits and maybe doubles. We're not swinging for home runs. The days of swinging for home runs were, a couple of years ago. And now is not the time to be taking huge speculative bets.
What would you consider a home run? Maybe just to set the baseline in terms of expectations as well. What is a base hit for you in terms of return? Well,
a base hit or a double is, most of our clients were trying to get a 7, high 6 to 10%, depending on your risk parameters, consistently every year. And so a base hit would be, 1 or 2% spread above short-term treasuries. And a home run, a double would be maybe a couple of basis points more than that. And a home run is in the high double digits. And so we don't do, we don't do a lot of the swinging for the fence, because you're going to strike out more. Is it Moneyball, the movie? And, I like that statistical approach of consistency, more predictability, narrowing the standard deviation, the bell curve of your future outlook. And that's just how we manage money. So we're not going to be a NVIDIA or those kinds of high flyers. And those I would call home runs. So we do line up a couple of them, but in an area of core competence. So we did some home runs on the energy space after 2020, where we tripled, quadrupled our money in some positions. Those are, when we see those types of situations come up, when oil went negative and these stocks are selling off 40% in a day, those don't come around. They'll maybe happen once in your lifetime. And so those are the types of, I wish we did more swinging for those, but they helped. We didn't lose any money when the markets corrected like 2 years ago, and they were down 15, even balanced portfolios down 15, 20%. We didn't lose any money. And that was because of those home runs. As a barbell approach, it really, those small positions generated huge returns, offset the losses in our broader market exposure. So we were flat. So, we didn't kill it, but we didn't lose a lot of money, and clients like not losing money.
Isn't that rule number 1? Don't lose money. I think it is. Rule number 1, don't lose my money.
Well, you also have to make money too. You also have to make money. There's the analogy in the Bible about, taking a coin and burying it in the ground. I mean, you got to use your talents, man. You always got to be investing. And that's where it gets tricky, where we're talking about, how do you invest in today's market environment? We've had such large moves. You go to cash, and so many people do that. I mean, it works out, but, you only have a few of those. You got 87, 2000, 2008, 2020. So, I mean, those, as I just mentioned, those are big wide gaps in between, and you missed out on some huge returns. So you always got to be making money.
So sort of put a bow around the conversation in general, like, and sort of maybe getting a little more specific on what you just mentioned is, if you were to invest $1 million right now, how would you allocate that?
Okay, so it depends. If I'm a conservative investor, I'm retired or about to retire, and I'm just looking to, like, the traditional way would be to cash out and do a ladder GIC strategy, get your 6%, and go to Costa Rica and enjoy your life and not have to worry about the ups and downs. You can't do that, even with interest rates being where they're at, and it's all short-term oriented. You got to be in the market, both public and a little bit of private as well too. But if you look at valuations, they've had a heck of a run. And so if you've got some new cash coming in today's market, you want to be able to protect yourself. And so what we're doing for our clients, especially newer ones coming in, we're using some of the gains that have been made to buy some hedging, for example. So you can buy some put protection on top of the portfolios. You can do some various option strategies or ETFs that implement those option strategies. We did one on the S&P, for example. From now until December, we're capping our upside at 10%. So we can't make more than 10%, but we probably don't see much more upside on the S&P beyond that, even getting there. And we don't lose money unless the S&P dips below 15%. So what I mean by that, if it's down 16%, we only lose 1% on that position. So we've got a hedge in there. We're not getting greedy. Base hit 9%. Well, that's more like a double from now until December. And then we're doing some structured notes as a fixed income replacement on with various downsides. So it's a alternative to fixed income. It's treated as fixed income, so you have to look at it from a tax perspective that way. But within registered accounts, it makes a lot of sense, and we're getting yields of 8 to 15% annualized with downside protection of 25 to 100%. We can also do ones that will track the full upside of a market with 100% downside protection. So we're doing a lot of these alternative types of investments. You have to understand them. You have to have an expert who understands options. You have to understand risk and how to put that into a portfolio. So it's creating a real big challenge for the do-it-yourselfer investors, where a lot of them are actually coming to us and saying, I don't know what to do. And I'm like, well, have you thought about looking at this? And so you have to build that level of trust, because it is a little bit different outside the box. But that's what you're paying the investment managers for. If you want to track the index, and then just go, I'll give you 3 or 4 ETFs for free and ideas, and you go track the index, but you're going to also track it to the downside as well. I mean, by having a nice diversified approach, looking at some of these alternatives investments. I've written about it in my Financial Post columns.
No, fantastic. Absolutely. It makes a lot of sense. So it sort of sums up the conversation. You do expect a bit of a correction. You don't expect the euphoria to continue. And that's sort of exactly reflected in what you just mentioned.
Well,
go ahead.
Yeah, I'm not yeah, I'll correct you on that. The euphoria can continue indefinitely for a lot longer than many expect. And markets can be irrational a lot longer than you can be solvent. So we want to be very careful about that. And so what I mean by that is that the probability is probably tilted towards more moderate returns going forward. Now, it doesn't mean those probabilities will play out. You can flip a coin 50-50 and get heads 5 times in a row, and you flip it, it's going to get heads the next time. But what I'm saying is that, yes, that euphoria could continue. That's why you want to be in the market, but you also don't want to get greedy. Use some of that euphoria to take advantage of. So what I mean by that is, for example, in the euphoria standpoint, people are buying a lot of calls. They're very optimistic about the market. And so you can sell those calls and harvest that premium. And people are very optimistic, not very bearish. The cost of insurance, like a put, is very, very cheap. And so you can buy that and use some of the gains you've made. And so I'm just saying, take that middle approach. I could be completely wrong, but if the markets continue euphoria mode, we're going to make money. And that's all that matters to our clients. If the market's correct, we're not going to correct with the market, and our clients like that as well.
Fantastic. Martin, I really appreciate you clarifying that. Really, really great insights. Tremendously enjoyed our conversation. We definitely have to do that again, especially talking about the Canadian markets. I don't do that often enough, despite being based here in Vancouver part-time at least. So happy to have you back on and see how the carbon tax is affecting the economy. Apparently, it's driving inflation already higher. So that's a political topic we don't need to get into. But
well, I call that the affordability tax. So.
Absolutely. I haven't checked gas prices today because I came down by bus at Seabus, but it was $2.03 a liter earlier in the week. So here in Vancouver. So I know you in Calgary are a bit blessed. So.
Well, we're blessed with less taxes, but certainly more snow. So if you're a skier like me, that's awesome. But I'm a minority, so a lot of us would love to live next to you in Vancouver. So if you got a basement suite, let me know, because that's about all we can afford.
Lots of basement suites available for rent out there because people need help coping with mortgages out here. Absolutely. Yeah. Fantastic. Martin, thank you so much for your time. Where can we find more of your work, by the way?
So I write every week for the Financial Post in the Investment Pro section. I've been doing that for, I can't believe, 15 years now. Time flies. I also am quite prolific on Twitter. I have a really good following there. Hopefully you can include that in the bio or in the description below. and building up my LinkedIn following as well too. So all three areas are great ways to follow my thoughts on the markets and politics and economy and all the fun stuff that we just discussed.
Amazing. No, we'll definitely link to it in the show notes down below as well, and direct people your way here. Really appreciate your time, and everybody else. Thank you so much for tuning in. I hope you found this conversation as interesting and insightful as I have. Learned a lot more about the Canadian markets. Sometimes we don't talk often enough about it, despite it being a big factor in North America as well. Of course, it's not as big as the U.S., but housing market, for instance, is an interesting topic of discussion, being based here in Vancouver, where houses barely stay on the market for a day or two and still get snatched up rather quickly. Interesting dynamics that people are already anticipating lower mortgages. So there is a frenzy. And as Martin pointed out, there is a massive shortage of houses and just homes in general. Really appreciate you watching. Thank you so much for tuning in. Do us a favor, please hit that subscribe button, leave a like, leave a comment. Are we asking the right questions? How are you protecting your wealth? How much longer do you think the euphoria is going to continue? Is it going to continue forever? Where's the end? Let us know. We do want to hear from you. We read every single comment, and we'll get back to you. Thank you so much for tuning in. We'll be back with lots more here on Soar Financially.